Good afternoon, ladies and gentlemen. Happy Friday and welcome to this version of Weekly Commentary. At the start of the week, I wrote that markets were facing a number of issues, any one of which could move markets potentially meaningfully this week. So let's see how we made out. Beginning the week, markets were having to digest new inflation numbers, very important NVIDIA earnings report, currently elevated interest rates, an escalating trade war now with Canada, increasing geopolitical uncertainty, and the Federal Reserve's important symposium at Jackson Hole. That is, folks, a lot for markets to absorb in a single week. Yet for the most part, markets handled the news better than I think many might have expected at the start of the week. So let's take these one at a time, starting with perhaps the most important data point that could impact the market direction over the next several weeks, and that is inflation. Wednesday, the PCE numbers that were released came in about as expected. Now, the headline month-over-month and year-over-year numbers were both 0.1% higher than expected at 3.7% and 3.3%. But the more important core PCE came in exactly as expected at 0.2% and 3.3%. Now, none of these numbers indicate a spike in inflation, but they all did show stubborn inflation that is not easing toward the Fed's desired 2% target rate. They're notably higher this go around as well than CPI, and that's because PCE gives less weight to housing and more weight to things like healthcare and services, including financial services. It also includes spending made on behalf of consumers, things like employer-paid health insurance and Medicare, Medicaid, among other things. So if those categories are rising faster than rents, cars, gasoline, etc., PCE can then come in above CPI. One interesting point right now is that the gap is especially noticeable in core inflation, because core PCE came in at 3.3% year over year versus core CPI at 2.5%. Now, that suggests that the categories weighted more heavily in PCE, particularly certain services, are currently running hotter than the categories that dominate CPI. Now, while that's not good news for anyone hoping for a rate cut this year, I'm not sure we're going to have a rate hike either. Services are running hot, and it does complicate Fed decisions. With CPI and core CPI, tariffs, the war, they're major and likely temporary contributors to inflation. AI is a third stubborn driver of inflation numbers, but the Fed can look past these numbers, especially AI, as sooner than later, AI will likely contribute to lower prices across the economy. The other two should prove temporary. But the CPI on the surface, the PCE, I should say, could be viewed as somewhat hawkish. However, the underlying details are less alarming. The data did find an interesting factor affecting this month's PCE, and it looks like I may be partially to blame. An unusually large contribution came from portfolio management and investment advisory fees. Now, while this may have negatively impacted PCE, it's actually good news for investors because this higher contributing number came from higher portfolio values, not higher fees, which means the Fed is likely going to look past those numbers as well. Now, greater wealth due to higher portfolio values, I should say, can, however, potentially be inflationary if that greater wealth translates into greater consumer spending, which, on the other hand, would be good news for GDP growth. This all points to what is a very complicated task for parsing inflation data, and it does make it difficult for Fed decision-making, which is likely one reason that we've been seeing more dissents than normal at FOMC meetings. Now, I think the odds for a rate cut are not thinking, looking at Kalshi and other odds makers, the odds for a rate cut or hike, the odds haven't changed at all in September because of these numbers. That's because they were pretty benign. And the Fed's likely going to review these PC numbers as headline hawkish, but details moderately reassuring. Now, on the earnings front, NVIDIA released important earnings and guidance Wednesday, which were once again huge and above analyst expectations. However, for the first time since May of 2024, The market rewarded these earnings to a meaningful degree, sending share prices up 8.75% yesterday. That's significant because 6 of the past 8 quarters, the stock actually fell after earnings despite great numbers. I believe yesterday's action can be viewed as a positive sign for the overall AI trade. Certainly was an encouraging development. On the interest rate front, interest rates this week actually dipped a bit, which is another positive development. Last Friday, the 10-year Treasury closed at 4.74% yield. Today, as I'm recording, it's at 4.67%. Also encouraging this week were developments in Iran. While nothing close to any kind of breakthrough has occurred, an encouraging development is a renewed diplomatic push. Qatar's prime minister was in Tehran yesterday trying to reopen a U.S.-Iran diplomatic channel. Now, that follows on the heels of visits by Pakistan's army chief and Oman's foreign minister. So several countries with working relationships on both sides are now actively pushing for de-escalation. There's also importantly been progress around the Strait of Hormuz. Iran and Oman, they're negotiating a temporary shipping quarter and mine clearing operation. And this has increased shipping traffic recently slightly, although it still remains well below normal levels. I think if an Oman-Iran arrangement is finalized, that could be an important first practical step toward reducing both military risk and oil price pressures. Now, another subtle positive, maybe not so subtle, the United States has begun returning diplomatic personnel to Middle Eastern embassies that were earlier evacuated. And while that doesn't guarantee a de-escalation, to me it suggests that U.S. security assessments see a lower risk, or immediate risk anyway, of a major regional de-escalation than they did previously. In other words, it looks like there's no imminent plans for an increase of hostilities from the United States part. For markets, I think the Hormuz talks are the most consequential positive development. A credible path toward reopening the strait could quickly lower the geopolitical premium in oil indirectly, help the inflation rates outlook we were discussing, and finally, today, we made it through Fed Chair Kevin Warsh's Jackson Hole Economic Symposium keynote speech. Past speeches have often had a meaningful and negative short-term impact on markets, most notably Jerome Powell's speech in 2022. After the significant downdrafts, however, this year, after Warsh's post-FOMC comments at the July meeting, markets were bracing for more, and instead the reaction was benign. Markets and interest rates barely moved during or in the immediate aftermath of his speech today. Now, the speech was set up as almost a no-win for Warsh in the markets, as if he came across too dovish, as he did in July, markets could tank and interest rates could spike, as what happened in July, fearing he wasn't being serious about fighting inflation. If he came off too hawkish, markets could tank and interest rates could spike, fearing a series of imminent rate hikes. Instead, he used a lot of words to basically say the employment market looks strong, but inflation is still too high, and they're unsure about whether inflation will begin making its way toward 2% without Fed intervention. Markets basically yawned and moved on. So overall, it was a pretty good week, and I want to thank you again for reading and/or watching, listening. In addition to the link in your email, the video version of this commentary can be found on social media sites, YouTube, and our Barcom Asset Management professional pages on both Facebook and Instagram. Now, folks, you know the way social media works. The more likes, positive comments, subscribers, etc., the more attention and the broader audience it receives. So if you love it, or even if you just like it and you have some time, by all means, please spread the love on these various sites. It would be very much appreciated by myself and all of us here at Barcom Asset Management. Thank you very much for your attention, and here's hoping you have a wonderful weekend. And until next week, stay safe.